Hello everyone, happy morning. Welcome to Revise and Recall Marathon session for CA Final Paper 7 Direct Taxes. I'm Emnath, I'm also a CA Final student. I'm very happy to host this session. I'm delighted to welcome CA Durkesh Singh sir, who will be taking today's DT Marathon session, which will provide the students the approach towards the exam. And I welcome all the beloved CA Final students. Students can post their questions in YouTube live chat box. We will take up the questions at the end of the session. 10 minutes before the end of the session, we will take up the questions. And I would like to introduce Durgesh Singh sir for the benefit of the students. Sir has got 17 years of teaching experience for CA final for direct taxes and indirect taxation. He has taught more than 40,000 students at CA final level and has pan-India reach. He is immensely popular with the students for his teaching skills on the subject. With the CA, he is a Big Four background person who is working as a partner in a large firm now with expertise in corporate and international taxation. I would like to hand over it to you, sir, for taking up the session. Thank you, sir.
Thank you, Hemant.
Thank you, sir.
Thank you for all the kind words. A very good morning to all the students. So all the SRC students here and all the students who are watching in the YouTube now. Students, this particular session, as the name suggests, revise and recall. The most effective revision and recollection, students, is through a practice. But the thing that comes to the mind of the students is that, sir, what to practice? See, students, direct tax law, the final revision has to always be through a practice. And when I say practice, it needs to be essentially be those important questions of all the topics for which you all need to do the practice. Now, what I have done, students, is that for the benefit of the students, I have prepared from the institute, ICAI, latest RTP, latest MTPs, May attempt RTP, and the MTPs. I have prepared all the entire material. And this is the super 50 question, students, that we have prepared for this particular session. I have two sessions today, one right now in the morning and another would be in the evening at 6 o'clock. Those students who would want this session, students, so this notes, we have put up the link. Students, we have put up the link in the description box of this video. You can download that particular notes. All of you can download that particular notes. You all can do that, students. Okay, so therefore, students, this particular solving, practicing, and I'm telling you, students, don't be surprised to find from this set of question, you may be lucky enough to find some 20 to 25 marks coverage from this particular set of question itself, because these are all from the ICAI resources, and the resources as latest as the latest MTPs, RTPs, last year MTPs, last year means May attempt RTPs, May attempt NTPs, and that makes the coverage very comprehensive. Those who have just joined in, I will again repeat the link of this particular notes. You can find it in the description box of the YouTube, this video, and you can download the notes and accordingly have it for your reference for the future. These are the topics, students, that we have covered. The coverage of the topics, I have given one thing, that all the topics has been arranged in systematic manner, and each topic will have its own set of practical questions, and more importantly, with and practical questions of, as I'm repeating again and again, of the latest RTPs, MTPs, etc. More importantly, students, if you see the last particular topic, which I have already marked it for all of you, and that is about, students, what? Which you can see yourself, various monetary threshold, students. Can you see that? Various monetary threshold, students. And through this various monetary threshold, students, you will all find that many students has got this query that, sir, monetary thresholds are very confusing, because we find it very difficult. to remember this. Don't worry, students. I have made that monetary thresholds towards the end for your benefit. Shall we start, students? Any good morning? Who are there right now, present, students? So accordingly, I can start. Any particular topic, students, of your interest that you all want me to take it first? Any particular topic of your interest, students, that you all want me to take it first? In the YouTube box, also, students, you can comment. Again, students, I'm repeating this. The notes of the Super 50 question. The link, the notes, you can find it in the description box. We have put up the link, and accordingly, you can find the link in the description box itself. Okay, of this video, of this YouTube video. Students, I'll start then, as per the request of many students yesterday, to cover up non-resident taxation and transfer pricing first. So we will first try to do with all the important questions of non-resident. I was talking about this, students. Can you see this? Charuta, good morning. So I was talking about this. Can you see this particular point, students? This is what I was talking about it. Many students get confused with this particular part. Monetary threshold. Just excuse me, students, I have to do it through my handwriting because the time was very limited for me. So that is the best I could have done it. So through the handwriting part, students, I have done it. But you will realize 4480, there is 2 crores limit. 165A also, there is a 2 crores limit, isn't it? The equalization levy. Like that, I have done it, students. And that is how I made it relevant for your reference. Okay. Again, I'm referring many students who are asking, sir, from where we will get the notes. It is in the description box of this video. You can download this note from the link given in the description box of the video. Shall we start? Charuta and students. So students, in the latest RTP and the MTPs of November as well as May, I found some really a beautiful question, students. So far as the non-resident taxation and transfer pricing are concerned, very new questions I've seen, which students, you are not aware of it. Some questions, students, are so brilliant that they are based on the amendment. So what I'm going to do, students, would be that I'm going to do a very quick revision of this first. I'm going to do a very quick revision, students, of this first, and then, students, we are going to take across one by one all our discussion. So let me start, students. In this context, MCQs I'll come. I'll choose my order, students. I'll choose my order of which question to be done first. That is how the order I will choose so that I can maximize my coverage in that limited particular time which I've got it. I've got 2 sessions today, students, right now in the morning and 6 o'clock also in the evening. So 2 sessions, let's make most out of it. Let's make most out of it, students. With that, students, I'll start first in the case of non-resident taxation, students. NR taxation, students. This question I'll take first, students. Brilliant question. Question number 34. Again, repeating, students, the notes of this, you'll find it in the description box of this particular video. Question number 34, students. This is the first question which I'm going to take first for all of you. Students, non-resident taxation, students, you will find, first of all, how you have to revise it. Last day revision, students, also I'm going to guide to all of you. This is going to be a very productive session for all of you, students. So in this context, if I have to tell to all of you in this regard, students, this is how it goes. In the context of the NR taxation, students, as you all would know, non-resident taxation, the first happens to be the residential status. Residential status, students. This is the first and the foremost point, students, that will come into play. Now, the most important arena, this is what I'm going to discuss right now, are herein in the case of residential status, that is of the individual and that is for the foreign company. Now, to students, I just need to tell you how you can expect the question in the examination so that every one of you are clear about the ICAI commitments. Every one of you. How you are going to find this, students, in your examination, students. This is how, students, you're going to do it. Be careful. Students, you will not find any independent question of residential status in your examination. That is the reason why I have taken this first question that I'm going to do. I just will tell you how these people are asking the question in the exam. You will not find any independent question. They will try to merge the concept of the residential status with that of any of the full-fledged question on the total income, or they will use integrated case studies, students. They will use integrated case studies for the purpose of capturing the essence of this entire concept. But don't expect independent question on individual and the rational status of a foreign company. Students, I'll start with first foreign company, because foreign company is the question which is given to us. And then after this question is over, then I will quickly run through the basic provision of the rational status of the individual. But let me first start with the foreign company. All of you students also will ensure to keep the notes ready with you. And please ensure to keep the calci ready with you, students. Calci, I want it. I'll give you, students, 15-20 seconds to ensure that the calci is there with all of you, students. Please ensure to keep the calci. Quickly, students, 20 seconds, because you will have to solve it, students. This is the last chance for all of you to solve the DT questions along with me. Quickly, students. Those who have just joined, please ensure that you will find the notes in the description box, students. 30 seconds, students. Please get the calci, all of you. So, students, so far as the foreign company is concerned, Kamal, all ready? So far as the foreign company is concerned, students, the residential status depends upon whether the foreign company satisfies the active business outside India test. There is an active business outside India test. Akash, good morning. Perfect. So, students, there is an active business outside India test that has to be fulfilled. Active business outside India test that has to be fulfilled. On that basis, we will decide where is the place of effective management of that foreign company, or for that matter, whether the foreign company can be considered as a resident in India or a resident outside India. So, if the foreign company satisfies the active business outside India test, so the answer can be yes, it satisfies, or the answer can be no, it does not satisfy. So if it satisfies, students, the active business outside India test, then the poem is presumed to be in India. Poem is presumed, students, to be in India. Presumed to be in India, provided to be in India, provided what? Majority of the board meetings are held in India. In India, provided what, students? Provided the majority of provided the majority of the board meetings are held outside India. Sekhar, yes, indeed, ABOI test. ABOI test, students. Majority of the board meetings are held outside India. All of you are clear with this one, students? I think all of you are aware of this one. Okay. But if the active business outside India test for that foreign company is not satisfied, then in that particular case, students, we have to check for that foreign company. What is that we have to check? Who is that person? Who is that person who takes the key managerial and the commercial decision for that particular foreign company? Who is that person who takes the key managerial, or who is that person who takes the key commercial and managerial decision for that particular company? And once you have decided who is that person who takes that particular key managerial and commercial decision for that foreign company, then the next question is where that decision is taken. And if that where is outside India, where it is taken, it is outside India, then in that case, students, again we will say what, students? That the foreign company's poem is outside India. So therefore, it is non-resident in India. But if that where happens to be in India, that is the key managerial and commercial decision is taken in India, then we will say that, students, that the poem of that foreign company is in India. The poem of that foreign company, students, is in India. Is that clear to all of you, students? Fine. So this is one basic particular proposition that has been there. Now, those who say, sir, what is this active business outside India test? So we all know active business outside India test, students, has got two elements. And what are the two elements? First is that the passive income of that foreign company, should not be more than 50% of its total income. The passive income of that foreign company should not be more than 50% of the total income. And the second one is that the passive income of that foreign company. Now, many students are asking, sir, what is this passive income? Passive income is royalty, fees for technical service, dividend, interest, capital gains. And also one more income. What is that one more income? Where purchase and sale of the goods and services has been taken from the AE and has been given to the AE. AE means associated enterprise. So if both the purchase as well as the sale of that particular goods has been from the AE and to the AE, then we will say that, students, we will say what? That yes, the business of that particular, we will say that particular business is a passive income. That particular transaction results into a passive income. So the passive income, students, should not be more than 50% of the total income. That is the point. And the next particular box, students, the next first box is of the passive income. And the next particular box, students, is that the three elements. What is that? The asset in India, the number of employees in India, and the last one, students, happens to be students, the payroll given to such employees in India. The payroll to such employees in India, students, all these items, students, should be again less than 50%. The presence of the asset in India, the presence of the number of employees in India, and the presence of the payroll given to such employees in India should be less than 50% of the total asset, or the 50% of the total employee, or the total payroll paid by that foreign company. That is what ABOI test is all about. So if you satisfy this ABOI test, then your poem will be presumed to be, just excuse me, students, your poem should be presumed to be outside India. If you satisfy the active business outside India test, then your poem is presumed to be outside India. And whereas the answer is no, if you don't satisfy the same, then in that case, it will all depend upon who is that person who's taking the key managerial and commercial decision for that foreign company. And the second one is where that decision is taken. I hope that all of you are clear, students. Any doubts up till here? Can we then take this question number 34? Straight away, students, question number 34. Notes, I'll keep on repeating. It is there in the link of the notes is given in the description box of this video. You can kindly ensure to download the same later on. Any doubt, students? Shall I then start with this question? One of the most important question for your November 22 attempt. All I have taken is from the ICAI RTPs, MTPs, last year RTPs, MTPs, so as to make the best 51 question. Amruta. Let's start then in this case. Vioni Inc. Incorporated, a company incorporated. Now, students, if possible, Yogita, if possible, students, ensure, Akash, that on the day of the examination, you people have, you can use one extra day off that you have got in the costing paper. If possible, select some of the questions that we are going to do it today, and do possible, if it is possible, do revise this question, students. Sekar, do revise this question, students. So that is my suggestion to all of you, just to ensure to do a good revision of this particular questions also on the day of the examination, so as to make yourself confident enough to tackle the examination in this case. Let's start. Vioni Inc. A company incorporated in Japan is engaged in development of infrastructure and providing the consultancy in the field. So it is a foreign company, students. Incorporated in Japan means a foreign company. During the financial year 21-22, students, during the financial year 21-22, its shareholder met in India. Now be careful, students, over here. Praising. Yes, praising. During the financial year 21-22. Yes, Sekar. Sekar, just yes, board meeting will be considered. During the financial year 21-22, its shareholders met in India for 3 times. Who is meeting? Shareholders are meeting. The first 2 meetings were held to discuss the modification of rights attached to the various classes of the shares. To discuss what, students? To discuss the various classes of, to discuss here, students, the modification of rights attached to various classes of shares. And the third meeting, students, yes, Hemant, and the third meeting was held to discuss and decide about the sale of the companies situated in India. Sale of the companies situated in India. 3 meetings were held by the shareholder. Please tell me here. Now, these are 3 meetings. I'll discuss that. Let's first read the question for completely. It provides the following additional information pertaining to the financial year 21-22. 21-22. First one, dividend declared by Miami Inc. A Japan-based company. So this foreign company, students, is receiving dividend from another foreign company. So first is the dividend. Second is the fees for technical service received from Government of India is 4,54,000 rupees. The fees for technical services, students, received is 4,54,000 rupees. Interest received from Mrs. O, a unit located in IFSC, in respect of money borrowed by Mrs. O. So in that case, students, they are receiving what? Interest income. They are receiving, students, interest income. From whom? From a unit which is located. Who is receiving interest income? The Japan company. The Japan company, the SSC Japan company. And who is paying the interest? A unit which is located in the IFSC. The unit which is located in the IFSC. Fourth one, students, on 26th of August 2021, Vioni Inc. sold 5,000 equity shares held by it in Indian company. So students, capital gains. There would be a capital gains implication. We will see on this. Now you tell me, students. Now finally the question is, be careful. Finally the question is, you are required to compute the total income of Vioni Inc. for assessment year 22-23, briefly explaining the relevant provision of the Income Tax Act 1961. My first question to all of you is whether this Japan, based on the question given to all of you right now by the ICAI, I think this is given in the latest RTP or the MTP, this question is there. So expected in your examination for November 22. My question therefore to all of you is, based on the facts which has been given to you, please tell me, students, whether these particular company, students, these companies, are they satisfying the active business outside India test? On the basis of this data which has been given to you in the question, my humble request to all of you is to please tell me, based on the data, is the foreign company satisfying the active business outside India test? Just based on the data which has been given to you in the question. What is your take, students, on this? Just based on the data which has been given to you in the question, what is your take, students? Are they satisfying the active business outside India test or not? That is the question to all of you. That is the question to all of you, students. So students, be careful on this particular part. You would have seen, based on the data given to you in the question, you would have seen that what they have given is only the details about the passive income. Where is the business income? Please tell me. What I told you, students, was that your passive income should not be more than 50% of the total income. And passive income constitutes dividend, interest, royalty, FTS, capital gains, isn't it? So that is what is the passive income. So going by the question, Akash praising, here the question to all of you is that, is your active business criteria, is it satisfied? We don't have any information about what is the business income of the Japan company. Whatever that they have given to us is only about the passive income, and therefore we can safely say that the passive income constitute the entire portion of the income of that foreign company, going by the facts of the case. Because whatever data that they have given to us is only for the passive income, and therefore, Kamal, what we will say, that the foreign company has passive income more than 50% of the total income, and hence the foreign company does not satisfy the active business outside India test. The foreign company does not satisfy the active business outside India test. And if the foreign company does not satisfy the active business outside India test, then I just taught you students, just now I taught you then how to determine the poem of that foreign company. How to determine if the foreign company does not satisfy the active business outside India test. If they don't satisfy the active business outside India test, then the way to then go about it is like this. You will first see, students, who is the person who takes the key managerial and the commercial decision of the foreign company. Who is the person who's taking the key managerial and the commercial decision of the foreign company, and where such decisions are taken. That is the basis to determine where the poem of that foreign company is situated. Which foreign company? The foreign company which does not satisfy the active business outside India test, isn't it? Now, if you see in this question, please tell me, if you see in this question, the shareholder, students, has met 3 times. Students, the shareholder have met 3 times, students. Can you see that? The shareholders have met 3 times. And where the shareholders have met 3 times, students, please tell me then, in this particular context, please tell me then, students, shareholder have met 3 times. Is that shareholder, by virtue of the information, are they taking the key managerial and the commercial decision for that foreign company? Going by this particular data, yes, it will be. The notes, students, it is there in the description box of the YouTube. The notes of this particular lecture is in the description box of the video. Students, there is a second revision class also in the evening 6 p.m. A continuation of this, okay? Second revision class is also there in the evening 6 p.m. Tell me one thing, students, then, in this case, are they taking any key managerial commercial decision? The shareholders are taking any key managerial commercial decision? Amruta, praising, no, they are not taking any key managerial or commercial decision. What they are taking is only the shareholding based decisions and some asset disposition. That is what they have done. So therefore, students, the shareholders who are meeting in India, they are not taking any commercial or managerial decisions for that foreign company. And hence, can we safely assume and conclude, that the poem of that particular foreign company is outside India? The poem of that particular the foreign company is outside India, because we will assume that the commercial and managerial decisions are taken place outside India, though the commercial and the managerial decisions are taken place outside India, though the shareholders are meeting in India for shareholding decisions or some asset decisions, something like that. So that is our conclusion, students. All of you agree to this one? That will be our conclusion, students. All of you will agree to this one. Okay, so the poem is outside India on the assumption. Which assumption, students? Assumption is, as I told you, the assumption, students, is that the commercial decisions are taken place outside India. So the poem is outside India. So if the poem is outside India, can we say that they are non-resident? If the poem is outside India, students, can we therefore say they are non-resident or not? Can we say that? Answer is yes. Answer is yes, students. So they are non-resident because the poem is outside India. The foreign company is a non-resident. Now, if the foreign company is non-resident, this Japan company is a non-resident. Now we have to compute the total income. So how do we go about it? First point, students, we have to compute the foreign company's total income. So this is how you have to write your answers first. I hope that all of you have got hold with this one. Now, the first one, if you see, dividend declared by Miyani Inc. a Japan-based company, 54,000 rupees. Please tell me, a non-resident earning dividend from another non-resident, will it form part of your total income? A non-resident earning dividend from another non-resident, will it form part of your total income? Answer is no. Answer is no, students. I hope that all of you will appreciate this one. So will it be this information, will it be considered? It will not be considered, students, at all. Let's go to the point number 2. Let's go to the point number 2. Fees for technical services received from Government of India. Students, fees for the technical services which is received from whom? Received from the government of India. Students, now just have a look. Akash praising Amrita, all of you, be careful. All the students, be careful. Now, this has been received. Students, there is a lot of dispute on this word received. Received, earned, they have got different meaning, different connotation. What are they? I'll let you know. Don't worry about that. But the fees for technical services received from Government of India is how much? Rupees 4,54,000. The Government of India utilized such technical services for a development project which they want to do in Nepal, outside India. Please tell me here in this case, if the government is making the payment, whether the payment is interest payment to whom? If the government is making the payment to a non-resident, of what? Of what they are making the payment? They are making the payment of interest. They are making the payment of royalty. They are making the payment of FTS. Then it does not matter that whether the government is making the payment of such amount to the non-resident in respect of their any projects in India or project outside India. It does not matter, students, whether that payment is in respect of their any projects in India or project outside India. But if students, if a resident who is making the payment, a resident or a non-resident who is making a payment to whom? To another non-resident. Payment to non-resident. Who is the payer? The payer can be either resident or he can also be a non-resident. Who is the recipient? Payee. Payee is a non-resident. What is the payment? Payment is interest, royalty, and FTS. Then what, students? Then essentially that payer should be making the payment. The payer should be making the payment in respect of their business or a source which is situated in India. Then the payer should be making the payment in respect of their business or a source which is situated in India. I hope that all of you are clear with this one. All of you are clear with this one, students. And that exactly is the point. So, students, this is how it has to be considered in this regard. So, students, fees for technical services received from Government of India. So, because Government of India is making the payment, you will not see whether the payment is in respect of, the project is, the government is making the payment for a project in India or a project outside India. We will not see that. For the non-resident who is receiving the amount of FTS, this income will always be deemed to accrue arise in India. Now, the question to all of you is that, students, this amount 4,54,000 rupees. Now, this is the most important and the deadliest discussion that we are going to have. Tell me one thing. This amount of rupees 4,54,000, will it be considered as net of TDS or it is gross of TDS? Please tell me. Net of TDS or gross of TDS, students, what is your take on this particular part? This amount of rupees 4,54,000, will this be considered as net of TDS or it will be gross amount? So, students, I must tell to all of you, in this particular case, that this particular amount, the word, this is where the real challenge is. Praising. Amruta, here be careful. Students, whenever the word is received, Akash, whenever the word is received, be careful, all of you students. Receive versus earned. Okay. Whenever the word is received, it is always received net of TDS, students. It is always received net of TDS. Whereas if it is earned, then this is gross. You can say earned or they can say income. Whatever be the wordings, that this is his income. This is his income. But the moment they use the word receive, it is always received net of TDS, students. Is that clear to all of you? Okay. Is that clear to all of you? So you will have to make a particular write-up over here. Now you tell me one thing, students. TDS, but first of all, First of all, be careful, students, over here. Tell me one thing. The fees for technical service, FTS, the fees for technical service, students, FTS, or the royalty income of non-resident, FTS or royalty income of whom? Non-resident. How is that assessed? So FTS or the royalty income, if you have to assess, students, the FTS or the royalty income, if you have to assess for a non-resident, I'm talking about it, students, then you have to check whether the NR has got a P in India. NR has P in India. That is what needs to be looked upon. A P in India, and the services are delivered through this P. So if the NR has got a P in India, students, you may be aware if the answer is yes or the answer is no. If the answer is yes, students, then in that particular case, the royalty or FTS is going to be assessed on net basis under 44DA. 44DA section is what is going to be applicable. So net basis, this particular royalty and FTS has to be considered, which implies that you get deduction of the expenditure in respect of the P, wholly and exclusively in respect of the P. That expenditure or the allowance of that particular P is allowed as deduction. But if the non-resident does not have, the permanent establishment in India, or they do have the permanent establishment in India, students, they do have the permanent establishment in India, but the services which the non-resident is giving is not routed through that permanent establishment in India. The services which the non-resident is giving is not routed through the permanent establishment in India. In that particular case, the royalty and the FTS will be assessed on gross basis, students, will be assessed on gross basis under section 115A, and that would be on gross basis, students. That would be on gross basis. Is that clear to all of you, students? On gross basis, and the way it would be assessed, 10%. 10% is the rate. Don't be careful. Now here would be the mistake. When it comes to TDS, students, when it comes to TDS, the rate is 10%. But please be careful that knowing the fact that the person who is there is the payee to whom you are making the payment is a non-resident. The payee to whom you are making a payment is a non-resident. The TDS that you will deduct, students, the TDS that you are going to deduct in this particular case would be after adding the HEC. So the TDS rate, because the payee is a non-resident, the TDS rate would be after adding to the HEC, students. All of you agree? All the TDS and TCS rate, students, is loaded with the HEC, if the other party is a non-resident. Or agree to this one, students? So therefore, the effective rate becomes 10.4. So effective rate becomes 10.4. So if effective rate becomes how much, students? 10.4. Now you tell me one thing. In this case, so if 100 is the gross amount, 10.4 is the TDS. 100 is the gross amount, 10.4 is the TDS. So 89.6 is the net amount. 89.6 is the net amount. Now this net amount is equal to, can I say, this net amount is the net what is received by the non-resident. Now how much is received by the non-resident? 4,54,000, students. How much is received by the non-resident? 4.54 lakhs. So how much is received, students, is 4,54,000. So if 89.6 is the net amount is received by the non-resident, in our question it is 4,54,000. Then how much is the gross? So do the cross multiplication and you'll get the answer, Yogita. And please tell me the cross multiplication amount, students, quickly. Students, again, I'm repeating, while you are calculating, again, I'm repeating, the notes of this PDF, you are going to find it in the description box. Kindly download it from the description box. Second point, students, is that today, second part of this revision class of DT would be played in 6 p.m. in the evening. Can you tell me, students, the gross amount? Can you tell me the gross amount, students, over here? Please tell me, students. I told you earlier also that the calci needs to be there. A mandatory practice, isn't it? A mandatory practice. Amruta, 5,66,900 5 lakhs, 66,000 students, 66,000, Akash, 97. Let's take this one then. 5,66,097. All of you agree to this one, students? Every one of you? Length and breadth of this particular country. Okay, now see the magic. See the magic what ICAI has done. Here, I will tell you the inconsistency of the ICAI. What ICAI has done? While computing their income, students, while computing the income in the semester, students, ICAI has taken this 4,54,000. Okay, you will say, sir, then in that case, our answer was right. We said that, sir, 4,54,000 is the gross amount. Don't conclude, students. I will show you in this same particular question in another RTP or the MTP. They, whenever the word that they have used, received, they have taken it on net basis. And when they are using the word earned or normal income, they are taking it as gross. So what to do then, students? You'll say, sir, in that case, in one question, they are taking on net basis. And in another question, they are taking on gross basis. What do we do in the examination? In the examination, students, you will do this approach. Be careful. You will go with received as net of TDS. Okay, but please be careful that you will always make an assumption, because only the assumption is going to save you in your examinations. Only the assumptions is going to save you in the examination, students. And what is the assumption that you're going to say? That since the amount is received underline by the non-resident, it is assumed that it is received net of TDS. And therefore, the income needs to be shown on gross value, and the gross value is this. So that is how you're going to go about it. I'm telling you again, students, this 4,54,000, you are seeing it over here. Okay, it implies ICAI has taken in this question on gross basis. But another question I will show you, receive word, same dividend or same FTS, it becomes gross. Sorry, it becomes net. It becomes their net. So let's try to make a conclusion, because now the examinations are approaching. We need to conclude. How do we go about it in the day of the examination? Received net basis, it means do it gross and put it in the total income. Is that clear to all of you, students? Now, shall we proceed further, students? Now, another quick point, students, which is there. So this is what is the beauty of the question, students. This is what is the beauty of the question. Now, if you see the next point, ultimate question of the ICAI. Point number 3, ultimate question of the ICAI, students. This is the adjustment number 3. And what is the adjustment number 3, students? Can you see that? Interest received from Mrs. O, a unit located in IFSC, in respect of money borrowed by Mrs. O. How much is that? Rupees 15,400. Charuta. Nobody is aware of this particular adjustment. What to do? Ultimate question, students. Students, the answer to that is this. This was the amendment of the Finance Act 2019. This was the amendment of the Finance Act 2019. And as per the amendment of the Finance Act 1920, if the unit located in the IFSC, please pay attention, all of you praising. If the unit which is located in the IFSC, if the unit which is situated in the IFSC, International Financial Service Center, if that particular unit, students, if that particular unit which is located in the IFSC, if that particular unit, students, which is located in the IFSC has taken a loan from a non-resident, has taken a loan from the non-resident on or after 1st September 2019, on or after 1st September 2019, students, then in that particular case, the interest earned by the non-resident out of such loan amount, the interest earned by the non-resident out of such loan amount, students, will qualify for a full exemption under section 1015. This was the amendment, students, of the Finance Act 2019. So this is the ultimate adjustment of the ICAI. These are not my adjustment. ICI RTP, ICI MTP adjustment, I'm telling to all of you students, these are not my adjustment. Is that clear to all of you? Again, I'm repeating students, this assumption part, which you need to do. If the word that they use is received, if the word that they have used is received, then you will always go with net of TDS assumption. And then you do the gross up. Then you do the gross up. Okay. And how do you do the gross up? You will take the rate and you will add the HEC on that rate. Why you will add the HEC on that rate? Because the recipient of that amount or the payee of the amount is the non-resident, and hence the addition of the HEC on the rate is necessary. And thereafter, you will do the gross up, and that gross up value is what has to be shown. So you will please make a note in your examination answer, and the note has to be that the word is used received, and therefore we are assuming that it is net of TDS. I hope that every one of you now are 200% clear about this. Last one, students, is about the capital gains, and this is about students 112A. The capital gains of 112A, quickly I'll just run through it and we'll then move to the next question. These shares, students, on 26th of August 2021, Vioni Inc. sold 5,000 equity shares held by it in an Indian company for rupees 89 per share. For rupees 89 per share, students. So in that particular case, students, in this scenario, Vioni Inc. sold 5,000 equity shares held by it in an Indian company for rupees 89 per share. These shares were bought by Vioni Inc. on 20th of June 2011 for rupees 64 per share. For how much, students? Rupees 64 per share. So obviously it is a long term. Both the purchase and the sale of the shares were effected through a recognized stock exchange in India. Fair market value of these shares were 31st Jan 2018 was rupees how much? Rupees 70 per share. Was rupees 70 per share, students. So now you tell me, students, in that case, 112A students capital gains. I hope that all of you are aware. 112A students full value of consideration, students, you already know. How much is the full value of consideration? The amount that they have received is 89 per share. 89 per share into 5,000. That is the full value of consideration. Now, the fact that you are doing the computation under 112A because it is a long-term capital asset, and the long-term capital asset is in the nature of shares, which is listed in a recognized stock exchange. The shares which is listed in the recognized stock exchange on which the STT has been paid, isn't it? So now in that case, students, we will say that the cost of acquisition, you don't give the indexation in 112A. Now, how do you do the cost of acquisition? This is how you do the cost of acquisition. Cost of acquisition in 112A has to be done in two following steps. And what are the two following steps, students, for the cost of acquisition? These are the two following steps, students, for the cost of acquisition. So step one, students, be careful. What is the step one and step two in this regard? What is the step one and step two, students? So step one, students, in this particular case, as you can see, step one is, it is the lower of what? The fair market value as on 31st of Jan 2018, or what, students? The second one, students, happens to be the full value of consideration itself. And whatever full value of consideration itself, and whatever is the qualifying amount, the lower amount, so this will be taken here in step two. So the qualifying amount, higher of what, students? Higher of over here, if you see, it is higher of the qualifying amount of step one. The qualifying amount of step one will be compared to what, students? The actual cost. So higher of these two will be the final. This will give you the cost of acquisition. This will give you the cost of acquisition under section 112. Is that clear to all of you? All of you are clear 100%, students? Every one of you? I hope that every one of you are clear with this particular proposition now, students. Shall we proceed now? If all of you are clear with this proposition, students, shall we proceed in this context? So this is how the cost of acquisition. Now I don't need to get you through. Let me take you to the next question. So students, this is what it is. Now students, let's come to our next part. After this, students, I will take you through the next important point. Beautiful question, students. Beautiful question. One of the deadliest MCQ of the ICAI. In the RTP and the MTP, students, we are going to do it now. One of the deadliest MCQ on non-resident taxation in the RTP and MTP, students. We are going to do it now, students. Let me take you through to that. One of the most expected question of your MCQ for November 2022 attempt. And that, where it is now, students, we need to find out where it has gone. It was just there in front of my eyes. Can you, this is what it is. Students, question number 2, most likely for November 22. ICAI questions are really very good when you see this MTPs and the RTPs and all. So students, just a second. If you can see, students, can you read this one? I'll give you, students, I'll give you 30 seconds. Just read the question, students. This is the question and these are the options. Read it, students. 1 minute time I'm giving you. So students, I hope that all of you are through this. Let me show you the last option. The PDF file, students, is there in the description box of the video. So students, if you see herein, MNOINC dot and PQRINC dot are two country M based companies. Now, students, be careful in your section number 9, which you have seen. This is your section number 9, income deemed to accrue in India. Okay, income deemed to accrue in India, students. Now, the first section 911, the first section 911, students, has got two aspects. Most important, most likely for your examination. One is the business connection in India. The first 911, because of this 911, what we say that the income is deemed to accrue as in India. The first one happens to be the business connection in India, students. Business connection in India. And the second one, students, happens to be for the indirect transfer. The second one, students, happens to be the indirect transfer. Okay. Now, students, so far as the business connection is concerned, let me now take you through to this slide. Okay, so one of the two can be there in the examination. Just be very careful. Let me take you through quickly. We will go through this one and then put across a discussion on this particular MCQ. So, students, here in the case of the business connection, in India, students, what happens over here is this, that there are two things. The non-resident can be said to have a business connection in India. Either this can be through the presence of the agent, who mainly or wholly students performs any one of the following three activities. Mainly or wholly performs any one of the following three activities. So there are three activities, students, which has been given. So any one of the following three activities they need to perform. The most important activity, students, do you know what is the most important activity? And the most important activity, students, in this case is that the agent plays a principal role. Agent plays what? A principal role, which leads to the conclusion of the contract. Which leads to the conclusion of the contract. Conclusion of the contract. So the agent is playing a principal role which is leading to the conclusion of the contract. That is one. There are other 2 points also, students. Other 2 points also, just keep this in mind. Agent is playing a principal role which leads to the conclusion of the contract. So students, be careful. The agent may not, students, the agent may not actually conclude the contract. Students, the agent may not actually conclude the contract. What is important over here is that they should play a principal role which leads to the conclusion of the contract. They should play a principal role which should lead to the conclusion of the contract. So actual conclusion of the contract is not necessary. Actual conclusion of the contract is not necessary. What is necessary, students, is playing a principal role which should lead to the conclusion of the contract. Which should lead to the conclusion of the contract. Is that clear to all of you? Every one of you, students? And that exactly is the point. So students, this is how it has to be considered over here. The rest of it are normal. Like the agent is stocking the goods of the non-resident. They are acting like a stockist. They are stocking the goods of the non-resident and delivering the goods as per the instruction of the non-resident. They are stocking the goods of the non-resident and thereafter delivering the goods as per the instruction of the non-resident. That is what is the point number 2, which is independent to point number 1. And point number 3, students, is the normal function of the agent. What is the normal function of the agent? Securing the order on behalf of the non-resident. Securing the order on behalf of the non-resident, that is your point number 3. So 1 or 2 or 3 is what students needs to be looked upon. 1 or 2 or 3 is what students needs to be looked upon. Is that clear to all of you, students? Every one of you? So this is how it has to be considered in this context. Now, students, very importantly, in this case, there is one exception which I just need to tell you, because based on that, there is an MCQ which has been put across. And what is the exception over here? The exception over here is this, that if an agent independently, students, in his normal course of business, if the agent in his normal course of business, if that agent is buying and selling the goods on behalf of the non-resident, if the agent is independently in his normal course of business is buying or selling the goods on behalf of the non-resident, in that particular case, students, what we will say? Indeed, in that particular case, students, we will say that the agent is not acting wholly or mainly on behalf of the non-resident, and because they are not acting wholly or mainly on behalf of the non-resident will not have any business connection in India. The non-resident will not have, students, any business connection in India because of such independent agent. I hope that every one of you are clear with this. So because of that independent agent, because of this independent agent, the non-resident will not be considered. As primarily having any business connection in India. Yes, praising. Now, this is what the business connection is all about. Point number one. And students, the second point is the significant economic presence. SEP. What is SEP? Significant economic presence. Significant economic presence, students. Significant economic presence, students. I hope that all of you are clear. Now, significant economic presence, when you see over here, what is that you're going to get, students? SEP. So far as a significant economic presence is concerned, there are two tests that the non-resident may not have his physical presence in India, but the non-resident may have a significant economic presence in India. So if the non-resident may not have any physical presence in India, but they have a significant economic presence in India, then students, in that particular case, can we say that the non-resident has a business connection in India? Answer is yes. If they have a significant economic presence in India, then yes, they can be said to have a business connection in India. So the question to all of you is, what constitute a significant economic presence? What constitute the significant economic presence? Two things, students, over here. And the two things are, number one, which we say over here in this context is that if, students, if the non-resident is selling the goods and the aggregate sale of goods or services, students, the aggregate sale of goods or services to whom? To person in India by a non-resident. To person in India. Please don't use the word resident. This is where you people lose the marks. The aggregate sale of goods or services to person in India by a non-resident. And can anyone tell me what is the value of that particular aggregate sale that should have taken place in the financial year? In a financial year, how much is the value? Should be in excess of rupees 2 crores. The aggregate sale of goods or services. The aggregate sale of goods or services to person in India by a non-resident in a financial year, students, indeed praising, should be in excess of rupees 2 crores. Or, Akash, or the second point is that, students, the second point in this case is that herein that if they don't have a sale, but they have got users in India, then in this case, the minimum user in India, the population of user in India should be at least 3 lakhs. You say, so what do you mean by user? Like, for example, I have got an app. I'm a non-resident, have got my app. Total number of downloads made by the users in India is, say, more than 3 lakhs. Say Netflix. So more than 3 lakhs people in India have done the download of my app. Then in that case, even if my total sale may not cross more than rupees 2 crores, but the fact that the number of user using my app is more than or at least rupees 3 lakhs, can the non-resident be said to have a significant economic presence in India? And the answer is yes. Now please come to this particular question. Beautiful question I said to all of you. And this is what it is. MNOINC dot and PQRINC dot are two country M-based companies engaged in trading of oilseeds. Okay. MNOINC sold oilseed of the value of 1.8 crores during the previous year, 2021-22. To whom they have sold, students? To XYZ, an Indian company. So the non-resident MNO selling the goods To whom? To Indian company XYZ Limited through an agent in Delhi who secures the order mainly for MNO INC dot. Mainly for MNO INC dot. So please tell me, because of the fact, the activity, because of the activity of the agent, because of the activity of agent in India, can we say that the MNO INC dot, that the MNO INC dot will be considered to have a business connection in India? Will we say that because of the activity of the agent on behalf of MNOINC dot, will that give rise to a business connection in India to MNOINC dot? And the answer is yes. Answer is yes, students. It will definitely will give rise to a business connection in India, students, and that exactly how it has to be considered. Now, the next one, students, if you see over here, PQR INC dot also sold oil seeds. Another foreign company, students, PQR or INC dot sold oil seeds of the value 2.10 crore during the previous year 21-22 to XYZ through an independent agent carrying on agency business in Mumbai. Through an independent agent carrying on agency business in Mumbai, students. The independent agent in Mumbai renders services to many other oil seeds trading companies which are not related to PQR INC dot in any manner. Both MNO INC dot and PQR INC dot does not have a P in India. Examine the taxability of income earned by MNO and PQR INC dot from the sale transaction with whom? With XYZ Limited based on the provision of section 9(1). Ignore DTAA. And the answer, students, is A. And the answer is A. MNO, students, has got a business connection in India because of the presence of agent in India. Answer is yes, because that agent is wholly or mainly performing the activity on behalf of the non-resident. All of you will agree to this. On behalf of the non-resident, every one of you will agree to this. But what about PQR INC dot? What about the PQR INC dot? So far as the PQR INC dot is concerned, for them, the agent in India is acting in an independent manner. The agent in India, students, is acting in an independent manner. When I say acting in independent manner, what does it imply? It implies is that, students, independently, they are buying and selling the goods. They are not saying that we are doing on behalf of it. So because of the agent, whether PQR INC dot, are they getting the exposure of business connection in India? Answer is no. Because of the agent, they are not getting the exposure of business connection in India. But please check what is the sale value that has taken place in respect of the goods of PQR INC dot. What is the sales value which has taken place in respect of the goods of PQR INC dot? And the sale value, students, you can see is more than rupees 2 crores. The sale value, students, over here is more than rupees 2 crores, 2.10 crore. And hence, can we say that PQR INC dot, because the aggregate sale made to persons in India is more than rupees 2 crores, therefore they have significant economic presence in India. Because of that reason, they have a significant economic presence in India. And the answer is yes. And because that they have got a significant economic presence in India, can we say that they have a business connection in India? Can we say that, students, they have a business connection in India? And the answer to that, students, is yes, they have a business connection in India. They have a business connection in India, students. I hope that all of you are clear with this one. Every one of you. Fine, students. So this is how both the person have got a beautiful question, students, isn't it? Now, students, the next question which has been there, which you can see over here, is about the treaty relief, the double taxation avoidance agreement treaty. Students, you people would have realized DTAA question of the ICI. DTAA question, students, of the ICI. Attempt after attempt, you would have known. Attempt after attempt, students, you would have known Known for what? So let me, before doing DTW, one more question. Question number 37. Again, most likely question. MTP, RTP, everywhere this question is there. Again, most likely. Everything is most likely, students. How much time to write, students? This most likely. I've selected the best lot of the question, primarily for all of you. So therefore, now I do this question with all of you, students. And then we'll take across one DTAA, and then the most expected case law, case study that we are going to do, students, with all of you. Most important case study. Okay, let's start. So here, question number 37, Trex Limited, a company incorporated in country number T. Students, where is Trex Limited incorporated? It is incorporated in country T, students. Has the following income in India during the year ended 31st March 2022. During the year ended 31st March 2022, students. So this company, which is incorporated in country T, has the following income in India during the year ended 31st March 2022. Compute the total income and tax liability of Trex Limited for the assessment year 22-23, assuming that its poem is outside India. Assuming what, students? Its poem is outside India. Now, point number 1, be careful. Interest of rupees 2,85,000 earned. Students, earned. What did I told you? Is it on gross or on net? Please tell me, if the word that is used is earned, then is it to be considered on a gross basis or it is to be considered on a net basis, students? Students, ensure to like the video and please ensure to share this video. This is one of the very important initiative taken by the ICAI. So ensure to that video reaches to across the segment so that the ICAI also undertakes such initiative for all of you in future. Okay. Do like this video and do share the video maximum, students. That is your responsibilities to all the groups. So students, in this case, please tell me the word used over here is earned. The word used over here is earned. So will I be considered net or gross? Amruta, Hemant, Akash, William. Indeed, it will be considered on gross basis. It will be considered on gross basis, and that exactly is the point. Okay. Now, students, interest income of the non-resident students, it is coming from what? It is coming from debentures. It is coming from debenture of rupees 30 lakhs issued on 1st August 2021 for a consideration of providing technical know-how to MNO Limited, which is an Indian company, and for the purpose of business carried out in India. Anand, be careful. Be careful, students. So far as interest income, students, I hope that all of you are aware of it. Interest income is concerned, the interest income of the non-resident, they are accessible under section 115A. Students, are you aware of that? They are accessible under 115A. And 115A, essentially, students, if you see, there is a 20% rate and there is a 4% or 5% rate as a case may be. This is the rate of tax under 115A for the non-resident. Okay, this is, I'm talking about the interest income of a non-resident. Now, always recap and revise and recall here, students. So far as interest income is concerned, let me take you through to the firstly 5% rate of tax. This rate I'm going to take you through first. This rate, students, I'm going to take you through first, and the rate is like this, students. Be careful. I told you already. So far as 5% rate is concerned, students, it is on the basis of 3 incomes. So far as the 5% rate is concerned, students, it is based on 3 incomes. Which are those 3 income, students? Let me tell you that then. The 3 income, students, which are being there are, students, the 3 incomes which I just want to mention to all of you is primarily are the if the investment is made by the non-resident in a long-term infrastructure bond. So what is the first amount? Long-term infrastructure bond. That is the first. On that interest income earned, 5% is the rate. Second, students, the second point, students, is if the interest income the non-resident is earning from rupee denominated bond, investment in rupee denominated bond, from that interest income also the effective rate of tax is 5%. And the last particular point, students, is what is the last particular point after rupee denominated bond, students? The last particular point, as you all can see, is in respect of what, students? Is in respect of the interest income earned by the non-resident from a business trust, So even that interest income earned by the non-resident from a business trust is accessible at the rate of 5%. Is accessible, students, at the rate of 5%. I hope that all of you are clear with this one. So these are the 5% cases. Now, if the same securities are listed in IFSC, if the same securities are listed where? In the IFSC. Which security? Long-term infra bond or rupee denominated bond or the business trust, the unit of the business trust, and those securities are subscribed by the non-resident, then the interest income from those securities will be taxed at the rate of 4%. Then the interest income, students, from those securities will be taxed at what rate? At the rate of 4%. I hope that all of you are clear with this one. Every one of you are clear with this proposition. Fine, students. And that exactly is the point. So therefore, there is either 5% rate or there is a 4% rate, students. Now, apart from that, other than this, the interest income earned by the non-resident, is taxed at the rate of 20%. Is taxed at the rate of 20%. By the way, students, I did not tell you or remind you that these rates are the flat rate of tax. These rates are essentially a flat rate of tax. You should be aware of that, isn't it? So these rates, students, are essentially a flat rate of tax. So for others, it is, students, 20%. For other students, it is how much? 20%. Okay, but for 20% rate of tax, there is one more condition. And what is the condition? Condition is that loan or the borrowings should be in foreign currency. That loan or the borrowing, students, should be in foreign currency, then and only then. So only if the loans and the borrowing is in the foreign currency, only if the loan and the borrowing, students, is in the foreign currency, that, students, that the rate of tax would be at 20%. Only if the loans or the borrowings would be in the foreign currency, that the rate of tax would be at 20%. Okay. Now you tell me, students, in this case, point number 1. This interest is from debenture. This interest is from debenture. So 5% is ruled out because 5% is very specific to only 3 items: rupee denominated bond, interest from the unit of business trust, and the last one was the long-term infrastructure bond. What about 20%? Whether 20% will it be applicable in this case? The answer is, students, no. Why? Because for that 20%, there is one condition, and the condition is that the borrowing or the debt should be owned in foreign currency. The borrowing or the debt should be owned in the foreign currency, whereas you can see over here, the debentures are issued by the Indian company. The debentures are issued by the Indian company in Indian rupee, and hence, students, it will be taxed 30 lakhs that you can see over here. Students, 30 lakhs that you all can see over here. This 30 lakhs, students, this 30 lakhs will be taxed at what rate? At the gross rate or the net rate, students. This 30 lakhs, students, will be taxed primarily at which rate? 115A rate? Answer is no. This would be the normal rate of tax. Normal rate of tax is what is going to be applicable. 115A is not going to be applicable over here because the debt is owned in Indian rupee. Now, what is the reason of the debt, students? Reason of this debt of 30 lakhs? So 30 lakhs of the debt is because the non-resident have to give fees for the non-resident have to receive from the resident the fees for technical service income. The non-resident has to receive from the resident what? The fees for technical service income. Now the resident, instead of paying the FTS income, students, the resident, instead of paying the FTS income, what the resident is doing? What the resident is doing? They are saying that, look, we have to give you FTS. So FTS is also the income of the non-resident because they have to pay. But instead of giving FTS, they are giving their debenture. So from that debenture also in future, there would be an interest. So there are two income that is there in this adjustment. One is the income towards the FTS, and second one, students, is the interest income. The FTS income, students, will be assessed under which section? 115A. FTS income, students, will go under 115A at the rate of 10%. Why 10%? Because just now we discussed in the last question that the royalty or FTS income will, the assessment of royalty and FTS income of the non-resident will depend upon which factor? The existence of the P in India and whether the services are routed through that P in India. But in this entire question, students, the P is not been mentioned at all. The P is not been mentioned at all, and therefore the assessment of this royalty and FTS will be under section 115A. The assessment, students, would be under section 115A, and that would be at 10%. For technical service, 10%. For technical service, students, 10%. And what about for interest? Interest, because it is not in the foreign currency, would be as per the normal rate. Would be as per the normal rate, students. Is that clear to all of you? This interest would be at the normal rate. I hope that all of you are clear with this one. All of you are clear with this one, students? Fine. So, students, there are two income of the non-resident that emerges from this. These are the two incomes. Now, coming to point number 2 over here, dividend of rupees. This is a beautiful thing. Dividend of rupees 6.5 lakhs earned in GDR receipt of Y Limited, an Indian company issued under the scheme of central government, against the initial issue of the shares of the company and purchased by Trex Limited in the foreign currency through an approved intermediary, students. Now this GDR, if you all see, this GDR income, students, ADR and GDR, one particular point, students. Just now I'll just tell you about, let's conclude. Assessment of interest income. I'll just give you the heading this way. Assessment of the interest income of the non-resident. This is very important, students, because this is where you people make mistake. Assessment of interest income of non-resident. So how the interest income is assessed in the hands of the non-resident, this is what I'm going to tell to all of you. So the interest income is accessible into 3 ways. One is 115 AC. First 115A. Another, students, is 115 AC. And herein, and 115 here AB. And the remaining is the other case. Now here, what comes? Please be careful. All the students are comfortable only when it comes to 115A. So 115A, I've told you, their rates are 5%, 4%, or there is another rate of 20%, but 20% has got. Now this has got 3 things. Which are the 3 things for that 5% or 4%? The 3 things, students, for that 5% or 4% is the rupee denominated bond, RDB. The second one is the long-term infra bond. And the third one, students, in this particular context is the from the business trust. The 20% others, but the borrowings in foreign currency. Okay. Now coming to this part, students are very uncomfortable. So this is, students, dividend or interest from. This is at 10%. 10% is the rate of interest. Charuta, are you aware of that? 10% is the rate of interest, students, for dividend and interest. 10% is the rate of tax for the dividend or interest under the section. If it is from the ADR and GDR, what we are doing it right now. And the second one, students, is, remember, bonds which are notified by the central government. This is what you should pick up in the question. Notified by whom? By the central government. The bonds which are being notified by the central government, in respect of that, the dividend and the interest income will be at 10%. The dividend or the interest income, students, will be at 10%. And so far as the others are concerned, as the others are concerned, what do we say about this one, students, then? So far as the others are concerned, students, what do we say about this? Others, the applicable rate to the person. Applicable rate to the person means the Finance Act rate. Whatever is the Finance Act rate. And you would appreciate that these sort of questions in the competition of total income of a non-resident is targeted frequently. Do you all agree to this? And have you all copied this one also? Have you all copied this one, students, also? So coming to this particular point, what we are discussing over here, students, can you see that? So dividend, let's come back. Let's come back, students. Dividend of rupees 6.5 lakhs earned. Students, the word used again is earned. Can you see that, students? The word used is earned. Earned on GDR. GDR of Y Limited, an Indian company, issued under the scheme of central government against what? Against the initial issue of shares of the company and purchased by Trex Limited in foreign currency through an approved intermediary. So if it is earned, students, then in that case, our final answer would be, what is our final answer, students? In that particular case, it is on gross basis. So am I supposed to consider it on net basis? No, it is on the gross basis. All of you agree to this one? Yes. Coming to point number 3, for dividend of 15,50,000, again, earned on equity shares of an Indian company. Earned on the equity shares of an Indian company. So tell me one thing, this dividend would be taxed at what rate? This is the equity share. So this is, again, this is under 115A, students, as you all are aware. So here you will go 115A, and for the dividend income earned by the non-resident, there is no other criteria but the criteria of 20%. The dividend earned from an Indian company, students, there is no other criteria but the criteria of 20%. Coming to the next one, income by way of royalty amounting to rupees 12,50,000. Hold your, students. Hold the horses. And be careful. Students, can you see this? Received. So what did I told you? Income by way of royalty amounting to rupees 12,56,470 received from Z Limited, an Indian company, in pursuance of an agreement approved by the central government, students, will be considering this on net basis? Yes. And at what rate the royalty would be assessed? 10%. Now, what is the TDS rate? Knowing the fact that the payee or the receiver is a non-resident, the TDS rate would be 10.4. The TDS would be at 10.4, students. And therefore, if it is 10.4, then the net after TDS is 89.6. The net after TDS, I already told you in the last particular question, the net after TDS is 89.6. So 89.6. So 12,56,470 is equal to 89.6, is equal to 89.6. Then how much is, students? Then how much is 100? So you will have to do the grossing up. Then how much is 100, students? Then you will do the grossing up. Is that clear to all of you? Every one of you, students, are you all clear with this one? That exactly how it has to be considered. Last is business income of 8,50,000 from a unit established in Delhi. So do we have a business connection in respect of this business income raising? Do we have a business income in respect of that? Do we have a business connection? In respect of this business income, yes, we have Amruta. 4 students have done the gross up. All the students have done the gross up of the royalty, and the gross up of the royalty is 14,02,310. 14,02,310. And let's see. 14 lakh. Congratulations, students. Indeed. 14,02,310. Isn't it? Now the last adjustment, students, point number 6. Last adjustment, point number 6. Long-term capital gains of rupees 1,32,000 on transfer of unlisted shares of an Indian company. Unlisted shares of an Indian company, students. Be careful. Students, if computed without indexation, the long-term capital gains would be 2,32,000. You all will be very careful on what I'm telling to you all. This is such a great question. If it is a, students, this is such a great question. I already told you this. If it is a, students, if it is a long-term capital asset, which is long-term capital asset being unlisted shares, which is transferred by a non-resident. Long-term capital asset being unlisted share which is transferred by a non-resident, then in that particular case, students, section 112 says no indexation will be allowed. Section 112 says no indexation. What section 112 says, students, in this particular context? No indexation. No indexation, and the rate would be at 10%. LTCG rate is 10%. This is what the situation is. This is what the situation is, friends. So in calculating the tax liability, will you take 132 or 232 then? With indexation 132 or without indexation 232? While calculating the tax liability, will you take with indexation at 132 or without indexation at 232? It has to be without indexation of 232. Can you see that? Without indexation of 232. Students, see for yourself. These are the magic which you can see. 2,32,000. So that is how you do this. Interest, I told you already, interest on debentures at the normal rate. Debenture interest would be at the normal rate or not? Debenture interest, will it be at a normal rate or not? Answer is yes. How much is that? 40%. Dividend GDR, 10%. Dividend income. Which dividend income? The other from the Indian company, 20%. And that exactly the point is. That, okay, sorry, above is also there. Business income. Business income, 40%. The normal business income is assessed in the normal basis. They have got P in India. It will be assessed normal basis. FTS income, students. Royalty, gross up you have done. Students, just now, okay. FTS, students, can you see that? Be careful. FTS. This is what you people make a mistake in the examination. Royalty and FTS, students, we only think of P. ICAI has done a googly now. We only say that for assessment of royalty and FTS income of the non-resident, what is that we see, students? We see that whether the non-resident has got a P in India or not. And if it has got a P in India, then we say what? Then whether the services are routed through the P in India, and only if the answer is yes, then we say that the assessment will be under 44DA. The assessment will be under 44DA. Otherwise, it will go under 115A. That is the limited understanding. But even if it does not have a P in India, but Then you will say, sir, then go to 115A. It does not have a P in India. Then please go to 115A, and in 115A, kindly ensure to tax it at 10%. No, you have to see that whether that technical services which they are providing to the Indian client, the technical services students that they are providing it to the Indian client, is it in pursuance of any agreement approved by the central government or not? The same also goes with the royalty. And here in this question for the FTS, the agreement was not approved by the central government, and hence the lower rate of 10% under 115A, the lower rate of 10% under 115A will not be applicable. Will not be applicable, students, in this regard. And let's have a look over here, students. Let's have a look, students, over here. Can you see this? Can you see this, students? All of you. For the FTS income. Now, students, all of you, for the FTS income, be careful. I just want you to read a couple of things very carefully. ICAI solution. You need to respect ICAI solution, students. FTS, they are saying it is not pursuant of the agreement approved by the central government. For royalty, they are saying in pursuance of the agreement approved by the central government. Okay, let's see what we have got from the question. Let's see what we have got from the question. Please have a look in this context. Please have a look in this context. In this particular context, students, for the FTS income now, is there anywhere written, students? You tell me quickly, students. Please read this one very carefully. This is the only particular data from where you are getting the FTS income. This is the only data where you are getting the FTS income. All of you agree to this one, Shekhar? And this is the only data in the question which you are getting for the royalty part. So one is for the FTS, providing technical know-how, and another is for the royalty part. Students. How in the solution the ICAI has written that royalty, royalty, students, has been approved, whereas for the FTS it is not approved? They have mentioned that point. If you have noticed that, how it is done in the question, students, please have a look. FTS not approved, royalty approved. How this, students, is based on praising. This is based on the assumption. And do you know, students, how the assumption has been arrived? Are you aware, students, how the assumption is arrived? The assumption, students, are arrived on the basis of this particular point. The assumptions are based on this particular point, that for royalty it is mentioned explicitly. For royalty it is mentioned explicitly, students, which you can all see. Income by way of royalty in pursuance of the agreement approved by the central government. So it is mentioned explicitly. What about for the technical know-how? Has it been mentioned explicitly? And the answer is no. It has not been mentioned explicitly so far as the technical know-how is concerned. And therefore, we are assuming over here, that is how you have to play the role now, 20 days down the line for your examination, that if the same question comes, this is what you will assume and write. Don't write just because you saw, unless you make an assumption even that way, that since the question for royalty, it is specifically given, But for FTS, nothing is mentioned about whether the agreement is approved by or not. And therefore, we are assuming that it is not approved, and hence the FTS income will be assessed at the rate of 40%. I hope that every one of you are clear with this, and this concludes one of the another very important question for your examination. Very important question for your examination, students. Now, with that, students, with this one, we go to one of the most important case studies, students, and expected you will remember me for that if it comes in the examination. So students, this is the beautiful question which has been there. Question number 32. This was there in the last attempt RTP also, based on a Supreme Court judgment, students. This was there in the last attempt RTP. But what I found in this attempt RTP is that apart from the judgment, they have put up a case study. And the answer is such greatly drafted that everyone will fall in love to this particular answer. Everyone, students. That is the ICAI students. Everyone will fall in love with this particular answer. And that is what I'm expecting to be in your examination also. So let me first, this case law is very technical, students, very technical case law. So let me give you a very simple understanding of this case law so that all of you can appreciate the same. Now, students, all of you do one thing. Students, quickly take, because this is such an important discussion. All of you are going to take 5 minutes break and then come back. 5 minutes break, students. So we will resume at 5:56 a.m., students. Quickly take a 5 minutes break and please come. In 5 minutes. Fine, students.
Hi, sir. We can continue. Yes.
Perfect. So, students, now all of you have to understand this case law because this is such a technical case law. ICAI 2 attempts back to back, students, 2 attempts back to back, they have put across this particular case law. And that is the reason why, students, that is the reason why this case law is of such a high value. Please understand this case law first, otherwise you will not be in a position to appreciate what they have written. And most likely again for November 22. So point number 1, students, is this. Students, point number 1. Students, I am an author of a book which is published by Bharat Law House. Okay. So what happens is that the original content belongs to me. The original content, students, belongs to me. And that content copyright, then I transfer it to Bharat Law House. That content copyright I transfer to Bharat Law House. Now Bharat Law House, that entire agreement is for what, students? The entire agreement is for the transfer of the entire agreement, students, is for the transfer of the copyright. And that copyright enables Bharat Law House to exploit. The copyright, students, enables Bharat Law House for what? To exploit that particular right. Exploit that particular right, students, and make number of copies. Isn't it? Now, for that, Bharat Law House, whatever they pay to me, can that amount be considered to be a royalty amount, students? Whatever Bharat Law House students pay to me, can that be considered as a royalty amount? And the answer is yes. It is a royalty amount towards the transfer of copyright. We will say that this is a royalty amount. This is the royalty amount, students. So therefore, this would be considered to be a royalty amount, the transfer which I have told you in this regard. Let's take example number 2. Or let's continue the same example. Now, after that, Bharat Law House will then make number of books and then sell it in the market. Sell it in the market. You as a student are buying that books. You as a student are buying the books. Now, students, in the books, you are being told that you are not given any right. You are not given, students, any right for the purpose of any exploitation. Do you get the right to exploit and make the number of copies? Does that right is given to you to take the photocopy or Xerox? Answer is no. That's another thing that students do it, but that they specifically say in their booklet that no part of this book should be reproduced in any form. They specifically say that no part of the book should be reproduced in any form, students. And that is what they specifically say over it. Do you all agree to this one, students? Do you all agree to this one, students? And therefore, now the question to all of you is, this, that whether in this particular case, whatever is the consideration that you people are paying to Bharat Law House, whether that will be considered as a payment towards royalty. Are you paying royalty to Bharat Law House? Answer is no. Answer is no. That your payment to Bharat Law House for buying that book cannot be considered as royalty. Now, one more thing before I will proceed. One more point before I proceed. And that point is, students, all the books are standardized. Whether you buy the book or your friend buys the same book, they are all standardized material. Standardized material is there, students. And if it is a standardized material, which is there with all of you, the payment that you pay to Bharat Law House, will it be considered to be a payment towards royalty? No. Your payment, students, is not a royalty payment. Your payment, students, is not a royalty payment. Your payment, students, is the payment for business. It's the business receipt. It's a business income for Bharat Law House. Isn't it? It's a business income for Bharat Law House. Fine. So that is what it is. So the payment which Bharat Law House is giving it to me, the payment that Bharat Law House student is giving it to me, can I consider that to be a royalty income? Yes. The payment that Bharat Law House students is The payment that Bharat Law House is giving it to you. Sorry, you are giving it to Bharat Law House. The payment that you are giving it to the Bharat Law House, is it a sale transaction for Bharat Law House? And if it is a sale transaction for Bharat Law House, will it be a business income? Isn't it? And the business income for a non-resident, we just now have read the business income for a non-resident is taxable only when there is a business connection in India. Only when there is a business connection in India, students. Isn't it? So that is what we have seen so far as non-resident is concerned, that the business income of a non-resident is taxable only if there is a business connection in India. Now, coming to this particular case law, students, this is about the computer software. Now, as far as the computer software is concerned, students, Bharat Law House makes sell the books to you. In that books, there is no right given to you to exploit the book further. That right is not there. You don't have the license to exploit. You only have the license to use. That is what Bharat Law House license is all about. The license which Bharat Law House has given it to you, that license is not to exploit it further. That license is only to use it, students. All of you agree to this one? Whereas what? Whereas in the case of here, be careful. Microsoft is also giving the computer software across the country. Microsoft is also giving the computer software across the country. All of you agree to this one? And the fact that Microsoft is giving the software across the country, the same conclusion will be there. You are buying Microsoft operating system. Your friend are buying Microsoft operating system, students. Are they standardized? It will operate the same way. Are they standardized material? Answer is yes. Now, do you get the right to use or right to exploit? Microsoft is giving you the right to use through that license or right to exploit it further. It is only the right to use the book which is made available to you, not right to exploit. So therefore, the consideration that you are giving it to Microsoft, is it a royalty? Royalty comes only when, like in my case, I gave the copyright to Bharat Law House to exploit it further. Then we can say that the consideration that Bharat Law House has paid to me, that the consideration that the Bharat Law House has paid to me is a consideration towards the royalty income. But this cannot be considered as a consideration towards the royalty because there is no right to exploit the things further, but it is limited only to right to use, just like the way Bharat Law House is giving it the books to you with a limited right to use, not the right to exploit. In the same way, Microsoft, which is distributing standardized software across the country, across the counter, those particular software has got a only right to use, but not or any further right to exploit, and hence the consideration that we are paying to Microsoft for that standardized software is a consideration towards what? Consideration towards royalty, or it is a consideration towards the sale of goods. It is a sale of goods. It is a business transaction for Microsoft. And because it is a business transaction or a sale of goods for Microsoft, therefore, it should be characterized as a business income. And the business income will be taxable in India only if there is a business connection in India. Only if there is a business connection in India. Isn't it? Now, see the magic what we have done. The income tax law, students, the income tax law has defined, students, the income tax law has defined this as what? As pay. This is a definition of royalty. Royalty definition of the income tax law is so wide enough. The royalty definition of the income tax law is so wide enough to say that or to suggest that any consideration which is paid towards the computer software, any consideration that is paid towards the computer software will be considered as royalty income. Any consideration paid towards the computer software or any computer software will be considered as royalty income. So therefore, they are characterizing this as royalty. So income tax law is characterizing this amount as a royalty. Whereas if you see, just now we have said that in the general understanding, is it a royalty that what we are giving it to Microsoft? No, it is not a royalty, because we don't have the right to exploit. The right is only to use. The way you people are getting the right in respect of the books, same way Microsoft is also giving only the right to use, not to exploit it further. And therefore, the license that has been sold is only for use and not to exploit. The license which the Microsoft has sold primarily is only for use, not to exploit it further. And hence what? And hence it should not be considered as royalty, but our law says it is a royalty. And if it is a royalty as per our law, as you all are aware, then the royalty income is deemed to accrue rise in India. The royalty income, students, will it be deemed to accrue rise in India? Answer is yes. The royalty income, students, in that particular case, will it be deemed to accrue or arise in India, because the payer is a resident? And therefore, if the payer is resident, then the royalty income to that non-resident will be always be deemed to accrue rise in India. So under the income tax law, it is a royalty. Under the income tax law, such payment made by the resident to the software provider who has sold you what he has sold you? Only the license to use and not the license to exploit. But still, the position that we take under the income tax law, the position, students, that we take under the income tax law is that it is a royalty. Accordingly, students, therefore it is taxed in India. What about the foreign country? In that country, in US, whether in US will it be taxed in US also, students? Whether in US will it be taxed in US also? Answer is yes. Because in US they will say it is a country of resident and therefore it is taxable in US also. Double taxation, students. And if there's a double taxation, you go to the treaty. And when you go to the treaty, students, what then the treaty definition you will see. Treaty definition you will see. Now, if you see the treaty definition of royalty, what do you think? They also will define the royalty in this way, students, that transfer of license or any transfer of right to use, any transfer of only, the transfer is only to of right to use. So if there is a sale of license which is given for use, the way Bharat law is selling the goods for use, that's it, not for any further exploitation. So what do you think in the treaty, the definition would be what? Royalty would be payment for what? Payment should be for the right to further exploit. They should have the right to further exploit the goods. Only then it could be considered as royalty. That is what is the general meaning. Unless that right exists with me, that I have the right to exploit that particular property, the payment cannot be considered as royalty. That is what we have discussed, students. The payment cannot be considered as royalty, isn't it? So therefore, under the treaty, the definition of royalty is very simple, and they say that the consideration for computer software will be a royalty only if, only what, students? Only if the consideration is paid for the license for exploiting the property. The license for exploiting the property or the computer software, only then it could be considered to be a royalty income. Only then it could be considered to be a royalty income. Whereas in this particular case, it cannot be considered as royalty income for the reason which I have told to you as per the treaty. So treaty says, as per the definition of treaty, such consideration paid for the standardized software which is for a sale of the license for only use, that's it. Treaty says not a royalty. Act says it is a royalty. What do you go to go? Treaty will override. Treaty will override. And if treaty overrides, students, and if treaty overrides, then in that particular case, treaty override will applicable. And if treaty overrides this scenario, then in that case, we'll say it is not taxable at all. It is not taxable at all as a royalty. If it has to be taxed, it has to be taxed as business income then. And business income can only be taxed if the non-resident has got a business connection or permanent establishment in India. The business income can only be taxed if the non-resident has a business connection or permanent establishment in India. All of you are clear with this particular point, students? Please tell me, every one of you are clear with this particular point? Quickly. So the treaty will prevail over the provision under the Act. The treaty will prevail over the provision under the Act. So treaty says not a royalty. Act says royalty. So it will not be taxable as royalty. So how it is going to be taxed? It is then going to be taxed as the business income, because then it is to be characterized Amruta as a business income, and business income, as you all know, could be taxed only if there is a business connection or a permanent establishment in India, isn't it? Up till here, it was all good. But ICAI has taken this case study to the ultimate level. Ultimate level, you people could not even think of it. So let's see what ICAI has done out of this question. Students, what ICAI has done out of this question, students? Let's have a look. Let's have a look, students, over here. Spacecraft Limited, an Indian company, has entered into a contract for 4.5 crores. Charuta has entered into a contract for 4.5 crores with DOT. Can you see that, students? With DOT INC dot country X for the financial year 21-22. Okay, that is fine. So spacecraft, students, spacecraft, an Indian company has entered into a contract for 4.5 crores with DOT INC dot country X for the financial year 21-22. DOT INC dot maintains an online web platform. Students, be careful. So from there, through the web, I have to buy the license. Through the web platform, I have to buy a license. But if it is through a web platform, if I have to buy that license of the computer software, the license is only for use, only for use, not to further exploit. Okay. But I have to buy that thing from a web platform. And if I have to buy it from the web platform, then can we say that in that situation, I can be considered as an e-commerce operator? Can I be considered as an e-commerce operator? That web platform which is maintained by DOT INC dot, the web platform maintained by DOT INC dot, can then that be considered as, students, can then that be considered as what? Can then that be considered as? Quickly. Say, students. Can then that be considered as an e-commerce operator? Can we say DOT INC dot is an e-commerce operator? Yes, we can say. Please pay attention. Who is the e-commerce operator? E-commerce operator is a person who maintains a web-based platform, and through that platform, students, he is either selling his own goods or services. Even Amazon is selling their own goods and services through the Amazon web platform, or he is facilitating others to sell their goods and services. He is facilitating others to sell their goods and services. Yogita. So therefore, over here, it becomes very clear that this DOT INC dot could be considered as a e-commerce operator, because it has a web-based platform where it is selling the license of its computer software. It is selling its license of its computer software for the purpose of use. For the purpose of use. So now, students, if that be the case, the condition is that this DOT INC dot should not have any permanent establishment in India. So therefore, if you see the last line, don't worry, students. Last line, if you see, DOT INC dot does not have any office outside the country X, so no P in India. And who is the service recipient? Indian company. Indian company. So therefore, whether the equalization levy of 165A, could that also be applicable? Because that is a dangerous thing now. We are outside the ambit of income tax discussion. Now we are in the equalization levy discussion. So people can say that, yes, sir, equalization levy is applicable, but be careful. 99% I'm sure that many of you are not even aware of this amendment. 99% I'm sure that many of you are not even aware of this amendment. This amendment, students, is both for 165, which is the Google tax, and 165A, which is the Amazon tax. And what they say is that the consideration, see, in the case of students 165, on that consideration paid, equalization levy of 6% has to be deducted. The equalization levy of 6% has to be deducted. Whereas in the case of section 165, the on the consideration which has been paid, the equalization levy primarily of 2% has to be paid by the service provider, which is the e-commerce operator. On that consideration amount, the equalization levy has to be paid at the rate of 2% by the service provider. Now, I told you that I'm sure that 99% of the students may not be aware of this amendment. And the amendment is, which is of the last year, not of the Finance Act 2020. From the consideration amount, they have said that the consideration on which the royalty has to be, the consideration on which the equalization levy has to be deducted or it has to be paid, that consideration amount will exclude what? Exclude the royalty or the FTS portion. So therefore, on the net consideration, the equalization levy on the net consideration, students, the equalization levy of 2% or 6% is what will be charged. Turnovers are there. Students, again, I'm telling you, this PDF file, you will find it in the description box of this particular video. Description of box of this particular YouTube video. Please, you will get those particular file and ensure that the last chapter of this particular PDF file has got a monetary threshold. Without fail, you will go through that. Without fail, students are going to go through that. Now, in this net consideration, equalization levy would be 2% or 6% as the case may be. Okay. Now, the question therefore is, the question over here is that now DOT INC dot, the consideration, students, now please tell me, the Indian company Spacecraft Limited, which is making the payment, to DOT INC dot towards the purchase of the license for the computer software, which is meant only for use, which is paid for the purchase of licensed software, which is meant only for use. So students, my question to all of you is, over here is this. What's the question, students, in this context? So my question to all of you students over here is this, that as far as the act is concerned, is it an equalization? Is it a royalty? Is it a payment towards the royalty? Answer is yes. As far as the act is concerned, we discussed already. If you go by the act, it's a royalty. And if it is a royalty, then what is that conclusion? Conclusion is that if it is a royalty amount, students, then our conclusion would be that this royalty amount will be excluded within the ambit of equalization levy. So no equalization levy on this royalty amount. Directly, he has to pay the income tax. The non-resident will be liable for income tax because this will be outside the scope of equalization levy, since the consideration amount exclude the royalty amount. This is when, if we consider that the consideration is considered as royalty, which is the case under the act. But now you go under the treaty. Students, now you go under the treaty, what you find? If you now go under the treaty, here what you find is that this consideration is not considered as a royalty amount. And if it is not considered as a royalty amount, then as we just now have said that the treaty will prevail over the act. Now, please tell me, if it is not considered as a royalty amount, then now you tell me, this is the business income. And business income under the income tax law, will happen only when there is a business connection in India. Isn't it? Or a permanent establishment in India. That is what is the scenario. But what about the equalization levy? Will the equalization levy of 165A will now be applicable if we go as per the treaty, which says that it is not a royalty income. It is not a royalty income, but it's a business income. So if we go by the treaty now, which does not say this consideration as a royalty income, but it characterizes the consideration as the business income, then the question to all of you is whether now the equalization levy under 165A at the rate of 2% on that consideration amount, will that be charged under the act? And the answer is yes, it will be charged. Why? Because treaty says not a royalty, and if it is not a royalty, will it form part of your equalization levy concept of 165A? Answer is yes, and hence 2% of the entire consideration amount will be considered for the purpose of tax. Did you all got this one, students? Beautiful question. Do you agree? That's the ultimate question, students. It just cannot go bigger than this. Just read this 2 paragraphs, students. That will help the cause. Is that clear, students? All of you through? So first, what we did in the earlier paragraph through the treaty, students. In the earlier paragraph, what we would have done through the treaty, we would have said that it's not a royalty, and therefore treaty will override the act, and hence it is concluded it's not a royalty. Once it is not a royalty, then whether the game is on of section 165A, answer is yes. Because if it is not a royalty, then definitely it will be within the ambit of the charge of 165A, and that is what we have done it. Now, students, the next particular point, students, is just this double taxation. Double taxation of the income, students. See, double taxation of income, students, one thing you should be very clear about it. Question number 33, which has been there in this context. In the context of the double taxation amount, students, the point which is very critical for all of you to understand is this. See what happens so far as the DTAA is concerned. Please pay attention, students. What happens so far as the DTAA, students, is concerned? This is what happens, students. See, as you all know, under the Income Tax Act, the resident in India, in respect of the double taxation of its income, the resident in India, students, in respect of the double taxation of income is concerned, that resident, students, please tell me, that resident, whether they will be if they earn any foreign income, then the foreign country will tax it. Then the foreign country will tax that income. India being the country of resident, they will also tax it. So therefore, India, for the double taxation on the foreign income, which is earned by whom? Which is earned by the resident, on that foreign income, students, that relief of the double taxation, is given by virtue of the tax credit method. What is the method applicable, students, over here? The method which is applicable over here is the tax credit method. How to calculate it? How do you go about tax credit method, students? So here we go, students, in the context of tax credit method. So in the tax credit method, students, this is what we all do, as you all are aware of this particular proposition. As you all are aware, students, in this particular proposition, so far as the tax credit method is concerned, so first of all, what you do is that there is a foreign income, there is an Indian income, whatever it be. Okay. Then you consider everything, get your GTI, then you have your chapter 6A. Then there is a chapter 6A. Thereafter, students, you get the total income. And once you have your total income, then you have your tax liability. And this tax liability you will calculate till HEC. Tax liability, students, you are going to calculate it till HEC, students. And now then, with the tax liability being calculated till the HEC, students, can you see this? With the tax liability calculated till the HEC, family, now you give the relief. Now the relief can be under section 90 if there is a treaty, or it could be under the 91 if there is no treaty. Okay, but the relief would be only through the method of which method? The foreign tax credit method. The foreign tax credit method. Now, students, this foreign tax credit method, how it works, primarily? In the case of the foreign tax credit method, this is what, students, we all are aware, that you will in fact take herein the foreign income which is subject to double taxation in both the countries. All of you agree? Which is subject to double taxation in both the countries, multiply by the eligible rate. And that is the relief. And finally, the net amount is the tax which is payable. The net amount, students, therefore, is the tax amount which is payable. This is all that we all do, students. All of you will agree to this one. The PDF file, again, I'm repeating, it is there in the description box of this YouTube channel, of this YouTube video. So, students, the foreign income, which you all can see over here in this context, the foreign income which is subject to double taxation in both the countries. On that, there is an eligible rate and the taxes is payable. Now, here, students, I just want to address 2 and 3 very important points, because on those 2 or 3 very important points only, you people make mistake in the examination. And that is what I need to be cautioning to all of you at this stage. That is what I need to be cautioning to all of you at this stage. So if you are copying it, then that's fine. So, students, first and foremost, the foreign income, students, generally, students, they give you in the INR. Generally, the foreign income, students, is given to you in INR, but can you expect that the foreign income can also be given to you in the foreign currency? Can you expect that the foreign income can also be given to you in foreign currency? Why not? In fact, that should be the case. And now recently, ICAI's question are drifting on that particular point, wherein they are giving you the foreign income in the foreign currency. They are drifting, students, on those particular cases where they are giving you the foreign income in the foreign currency. And then, students, what you all do in this context? And then, students, what you all do? Then that particular foreign income which is given to you in the foreign currency is then converted into INR. And what is the mode of conversion of that foreign income into the INR? So the mode of conversion of the foreign income into INR is probably, how do you convert the foreign income into INR? Please pay attention. 4 incomes. Which are the 4 incomes? Salary, interest, dividend, capital gains. Salary, interest, dividend, capital gain. So far as these 4 income is concerned, students, you will take up the conversion rate as the TT buying rate. The conversion rate as the TT buying rate as on the last date, students, as on the last date of the preceding month. Preceding which month? The month in which these income have accrued. The last date of the preceding month. Preceding to which month? The month in which these income has accrued. So therefore, in this case, like how capital gains gets accrued to the SSC, so the capital gain, students, gets accrued to the SSC if on the transfer of the capital asset in India. On the transfer of the capital asset in India, the capital gains gets accrued. All of you agree to this one? Yes. Second particular point, students, if you all will see, the second particular point, students, if you all will see. So this is about the capital gains. This, students, is all about the capital gains. The second particular point, students, once the this is for the foreign income. What about for business income? If supposingly the foreign income is in the nature of a business income, or if it is in the nature of house property income, and that income is denominated in the foreign currency, then how to denominate it in the Indian rupee? So the way to denominate, students, in the Indian rupee is by applying the TT buying rate. By applying what? The TT buying rate as on the last day of the previous year. The TT buying rate, students, as on the last date of the previous year is what you need to consider, and take that into account, multiply that into with the foreign currency amount, and that will give you the foreign income. And that will give you, students, the foreign income. I hope that all of you are clear with this one. So, students, this is how you get the foreign income, students, in this context. This is how, students, you get the foreign income, students, in this context. Fine, students. All of you. So, students, over here, with this particular proposition, primarily, you have converted the foreign income into INR. You all have converted the foreign income into INR. Indian income, that is fine. Rest of everything is fine. Now just be very careful about, this part. When I told you about the foreign tax credit method, how the method works. So you have to give a credit of the foreign tax that you have paid. How do you give the credit? The credit would be, you will first take what is the amount of the foreign income. What is the amount of the foreign income which is subject to a double taxation? But be careful, before we discuss that, I should tell you that the credit should be given for each source separately. If supposedly you have got more than one source of the foreign income given to you in the question, then you should be giving for each source the credit separately. This, in the ICAI past year question paper, you may not have seen it. The past year question paper, students, you may not have seen it, that we are giving the credit for each source separately. On the contrary, what we see is that there is a clubbing that we all do. Supposedly in that country, he has got interest income. He may have got some agricultural income in that country, so on and so forth. So what we have seen is that we actually do the add of all the foreign income, and thereafter we give the credit. That is done, students, only when the rate of tax is the same, because every particular income has got a common foreign rate, and that foreign rate is compared with the Indian rate. Whichever is lower becomes the eligible rate. So the fact that all these incomes are subject to the common rate of tax, therefore we never bothered ourselves to compute the credit separately. But if you are getting in the question that there are, say, 2 incomes or 3 incomes in that country X, and there is a specific rate for a particular income, and there is a other rate for the other income. So therefore, if such is a situation, then you have to ensure to take the credit for each source separately. For each source separately, you will have to take the credit, students, for each source separately. Is that clear to all of you? That is how the things has to be looked upon. You will have to take up the credit for each source separately. Okay, so just check in the question whether they are giving to all of you a particular foreign rate which is same, singular, or for more than one income, there are distinct rates which are being given. If there are distinct rate, then in that case, for each source separately, you will calculate the credit separately. However, so in that case, this is what you should always keep in mind. But nevertheless, so the eligible rate, what is the eligible rate? The foreign rate is compared with the Indian rate. How do you get the Indian rate, by the way? How do you calculate the Indian rate? So Indian rate is like your tax liability till HEC divided by this one. So take the percentage, this will give you the Indian rate. Take the percentage, students, this will give you the Indian rate, and that exactly the point. That exactly is the point, students. So take the percentage, this will give you, students, the Indian rate. I hope that all of you are clear with this one. Every one of you. So this is how the Indian rate would be there. So compare the Indian rate. Students, compare the Indian rate with the foreign rate. Lower of the two is the eligible rate. Now that eligible rate has to be applied on what? On the foreign income. Now then that eligible rate has to be applied on what? On the foreign income, and the foreign income which is subject to double taxation in both the countries. The foreign income which is subject to double taxation in both the countries, students. And that exactly is the point. The foreign income which is subject to the double taxation in both the countries. Now, please be careful. And I will tell you what is a twist which ICAI has made in the last attempt. Students, what happens is that many a times they are telling you, now you are a resident, you have got a foreign income. Now they will tell you that there is a brought forward losses in that country. There is a brought forward losses in that country which is not subject to the set off in that country. Remember that question of Amruta and Kalpesh, which is already there in your modules. So therefore, there is a foreign income which is earned in the foreign country, which is not subject to what? Which is not subject to the set off of the brought forward business loss as per their law. But then when we have to compute the total income of this resident, students, when we have to compute the total income of this resident, do we follow that foreign law or we have to go with our law? We will follow our law. Why will go with the foreign law in that case? Isn't it? So we will follow our own law. And therefore, whether we will give the set off of that particular loss from this particular income, yes, unless and until in our particular act there is any restriction, we will definitely give the benefit of the set off. So what we do, we give the benefit of the set off. Now what happens? Students? They may have taxed that foreign income without set off. We have tax that foreign income after set off. So therefore, the foreign income which is subject to double taxation, that much of the portion has been reduced. The foreign income which is subject to double taxation, that much portion has been reduced. Example number 2, students now. Example number 2. Remember house property. I have got a house property in foreign country. In that foreign country, I'm getting a rent. On that rent, the tenant is deducting the tax. In that foreign country, the tenant is deducting the tax and paying to the foreign government. Now, he is deducting the tax on the gross amount. Whereas in our particular case, the rent will form part of my total income, but only the NAV is forming a part of my total income. Only the NAV will form part of my total income, and the NAV is after the deduction of municipal tax. There is a standard deduction, and then there is a deduction towards the interest. So then the net portion of the annual value will form part of your total income, and on that there will be a tax liability that will be calculated. So therefore, what happens now, students, in this case? The total income, the foreign income, which is subject to double taxation. Which foreign income? The rental income. The rental income, which is subject to double taxation in both the country, is reduced. The rental income, which is subject to double taxation in both the country, is it reduced? Answer is yes. The rental income, which is taxable in both the countries, students, is reduced. To that, the answer is yes, students. It is very much reduced. I hope that every one of you are clear with this point now. Every one of you students are clear with this point now. So the rental income, students, is definitely students will be reduced in the computation of total income. Okay. Third example, number 3. I will give you one more example because this is how you should be very clear about it. Royalty income. This is a very popular question of Mr. Kalpesh. Remember that Kalpesh question which is there in the module. In that, Mr. Kalpesh has earned royalty income from foreign country. And on that royalty income, the tax was being deducted in that foreign country. Now, in India, what happens? They have given you a question that to earn that royalty income, Mr. Kalpesh has incurred some expenditure. To earn that particular royalty income, Mr. Kalpesh has incurred some expenditure. Whether that expenditure will be reduced from that royalty income? Answer is yes. Because see, This is the royalty income earned by a resident, not by a non-resident. So therefore, if it is a royalty income which is earned by a resident, if it is a royalty income which is earned by a resident, we don't have any problem on that. If it is a royalty income which is earned by a resident, is it taxable at a special rate or it is taxable at the normal rate? At the normal rate. If it is a royalty income earned by a resident, then students, in this case, it is taxed at the normal rate. Do you all agree to this one? Yes. And now if it is taxable at the normal rate for a resident, the royalty income, will it be subject to the deduction of expenditure? Yes. And in that Kalpesh question, this royalty income was in respect of this copyright. Copyright. He has authored some foreign textbooks, so he is getting a copyright. And because of that, he is also getting an additional deduction in chapter 6A, which is 80 QQB, maximum of rupees 3 lakhs. Whether that rupees 3 lakhs also will be reduced. Answer is yes. So see, by reducing so much of the amount, your royalty income gets reduced drastically. By reducing so much of the amount, students, your royalty income, which ultimately forms part of the total income on which the tax is calculated, reduce drastically. Gets reduced drastically. And therefore, now how much is the royalty income being the foreign income which is subject to double taxation? That royalty income would be that portion of royalty income which is finally entered in the process of your computation of the total income. That royalty income which is finally has entered in the process of the computation of your total income. Is that clear to all of you students? Every one of you? Last question, students, which is your May 22 attempt. Brilliant question, students. Brilliant question, May 22. In the May 22, they have reversed the entire gear. Do you know what they did? In the May 22, there was one deduction which was given on that foreign income in the foreign country. In the foreign country, there was a deduction which was being given on that income in the foreign country, but that deduction was not given correspondingly under the Act. That deduction was not given correspondingly, students, under the Act. This was the real bone of contention. That this deduction was being given to you. This deduction, students, was given to you where? Primarily under the law of the foreign country, but under the income tax law, there was no such deduction. And therefore, students, what happened in this case? Be careful, students. In this particular case, what happened? Herein, in India, that foreign income forming a part of a total income. In India, the foreign income forming the part of my total income was on the higher side as compared to the foreign income getting taxed in the foreign country. That was very much on a lower side. That was very much on a lower side because the deduction was given. So therefore, how much is the portion of the foreign income which is charged to double taxation in both the country? How much is the portion of the foreign income which is charged to double taxation in both the country? You will select that foreign income which was finally taxed in that foreign country because that was a reduced amount. And that much is the portion of the foreign income which is finally taxed in the foreign country. Is that clear to all of you now? Every one of you are clear with this or not? Quickly, students. Fine. So this is on the context of the double taxation law. And now, students, we come to the transfer pricing. Students, the question is simple here. The question which I'm pushing it, that is a question, simple question, but you may see. Students, this part is left out. This, I will not be in a position to do it right now because this is a bit heavy. But I must say, the RTP question of this is again most likely. Nobody has understood what this is. And ICAI has put up in the RTP and the MTP. Nobody has understood what it is. And the ICAI has put up in the RTP and the MTP. That in the evening session, students, are you aware that 6 p.m. in the evening also we have got second class? 6 p.m. And I'm requesting if I can get one more session, 3 class. So let me see if that is allocated, but at least we are confirmed with 2 sessions. So we'll go with that presently. Now, students, in this context, the transfer pricing provision, students, the ultimate thing, let's directly do with this transfer pricing. Couple of questions are there. So we can just do this. Thin capitalization is very simple. So I'm not touching upon the thin capitalization, but I just need to do with all of you one ultimate question, students. One ultimate question of NJA. Thin capitalization is simple. So what is left here? Only this is a real question. And there's a chapter 6 here. Again, the case of students, evening session would be a very important session for all of you. Let's see. I'll just request ma'am also to, if one more session so that I can cover up all the other remaining question also. In the transfer pricing part, students. In the transfer pricing part, students, will you be like fine to have one more additional session after evening so that I can put a request? You can just let me know. So accordingly, I can just ask if you all are wanting it. But only then I will be doing it in this context. Now, coming on the transfer price part, students. Coming on the transfer price part, students, ultimate particular thing which is there. This is again a new question. Again a new question, students. The transfer pricing part, students, in this context. What is the newness about this? Let's have a look. Kamal, praising. So if you see over here, Amruta, Nitya, Akash. So everyone is demanding to have one extra session after the evening today. So I'll just request ma'am to allocate one so that that same would be undertaken. Students, all of you subscribe the SIRC also, SIRC channel, so that lectures are notified to all of you. In this case, Yogita. KP Limited. The SSC has sold goods on 13th of December 2020. Be careful, students. KP Limited, SSC has sold goods on 13th of December 2020 to LM Limited, located in NJA. Students, can you see that? Beautiful question, students. Actually, there's one beautiful point in this. Has sold, again, ICAI question. No? They are all ICAI question. MTP, RTP, I'm not now aware, but either from MTP or from RTP. So KP Limited, the SSC has sold goods on 13th of December 2020 to LM Limited, located in the notified jurisdiction area NJ for rupees 11.4 crores. For rupees 11.4 crores. During the current financial year, KP Limited charged 12.6 crores from XY of US and 13.2 crores from RS of London, students. So students, be careful. Here in KP has charged 12.6 from whom? From XY of US and RS of London. Sale of identical goods, two comparables, and both of which are neither associated enterprise of KP Limited, nor they are situated in NJ. Do you know what they have done? Up till now in your examination, students, Charuta, up till now in the examination, students, they used to give you only one comparable on the basis of which you used to apply the relevant methods. You used to apply the relevant method, and by applying the relevant method, the ALP used to be determined. By applying the relevant method, students, the ALP used to be determined. However, now, be careful, students. However, students, now, what these people will have, what they have given you two comparables. So if they have given you two comparable, students, all of you are aware that then you will apply the applicable method. You will apply the applicable method on the data of both these comparables. And if you apply the data, if you apply the method on the data of both these comparables, you will get two ALPs, two comparables, two ALPs. All of you agree to this one? Two comparables, two ALP, students. Do you all agree to this? And because you have got two ALP, students, in that particular case, you will then do the average. Because of that reason, students, you will do the average. You know, you have to do the average. There is a situation which has been there. And then that average is what is considered. But the point, there are a couple of points which is so beautiful of this question. And what is that? Point number one. Students, in the past, ICAI has asked question on NJ. It's not that it has not asked the question on notified jurisdiction area. It did had asked the question on the NJ in the past. But what was the difference earlier and what is the difference now? What was the difference, students, earlier and what is the difference now? Earlier, they used to give you like an MCQ thing. And in the MCQ thing, they used to ask how much is the TDS that will be deducted. And then the rate was 30%. Then the expenditure used to be disallowed for the amount which you used to pay to the party which is located in the NJ. So those were the kind of question which was given for the NJ reference. But here is the question wherein there is a party with whom you have done a transaction and they want you to compute the arm's length price. So do you know what happens? So the party which is located in the NJA, the party which is located in the NJA, that party may not be your associated enterprise. That party may not be your associated enterprise, but the fact is this, that it is in the NJA. But the fact is this, that it is in the NJA. Because it is in the NJA, therefore, the transfer pricing provision is applicable and the ALP has to be computed in respect of that transaction. The ALP has to be computed in respect of that transaction. Okay, so that is precisely the new thing which is there in this question, that they are forcing you to compute the ALP in respect of the transaction that is undertaken with the party which is situated in the NJA. With the party which is situated in the NJA. That is, students, point number 1. The second point which they have given it to all of you is the comparable data. Both the comparable of 12.6 and 13.2 crores. These comparable of 12.6, that's now the last point is there. A beautiful point is coming. Last point is there, students, and this is a beautiful point. With 12.6 and 13.2, they are uncontrolled transaction. Below this, students, please have a look. While sales to XY and RS was on CIF. CIF means uncontrolled transaction was on CIF. The NJ with the transaction with NJ, it was in FOB. So if it was on FOB, what I need to do? I also need to ensure that the comparable transaction price is brought down to the FOB value. The comparable transaction price is brought down to the FOB value. And therefore, in that case, students, therefore, in that particular case, will I be reducing the freight and the insurance? Will I be reducing the freight and the insurance to that? The answer is yes, I will be. So what I will reduce is 20. I'll reduce 20, students. So therefore, from this price which is charged to 2 comparable, I will reduce this one, and that is what will give me the final ALP. I'll take the average. I'll then take the average arithmetic mean. Now, students, are you aware if the comparable size is less than 6 and the method applied is the cup method, resale price method, or the cost plus method, or the transaction net margin method, and the comparable size is less than 6, then in that particular case, we follow the arithmetic mean. And here also we will do the arithmetic mean. The cup method is followed and there are 2 comparable, and hence whatever is the ALP which is determined as per the cup method, I am going with the average. I am going with the average, students, in this case. Okay. Now, students, at the same time, you all are aware that there is a 3% tolerable band. What is this 3% of tolerable band? The arithmetic mean will be compared with the arithmetic mean, students, will be compared with what? Will be compared with the transfer price. Will be compared with the transfer price, and the difference, which is the difference, students, which is the difference, is then compared with the transfer price and check whether it is exceeding 3% or not. And if it is not exceeding 3%, then we ignore the difference. We ignore the difference and we go with the transfer price. But if the difference is more than 3% of the transfer price, if the difference is more than 3% of the transfer price, then, students, we will reject the transfer price and we will consider the ALP as the finality. We'll consider the ALP as the finality, and on that basis, the conclusion has to be drawn. Is that clear to all of you, students? All of you are clear with this one? Okay. However, now you people have not learned this thing at all earlier. And what is that? This 3% tolerable band. This 3% tolerable band calculation that we discussed just now, this is not applicable in respect of the transaction which is carried out with the entity located in the NJA. Is not applicable with the transaction in respect of the transaction with the entity located in the NJ. What does it imply? It implies this, that even if, students, even if in this particular context, yes, praising, even if in this particular context, the difference may be less than 3%, the difference may be less than 3%, students, even if the difference is less than 3%, in that particular case, students, what is that we will say? Even if the difference is less than 3%, still whether the difference, will it be added of the SSC in computing the total income? Whether the difference, will it be added in computing the total income? To that the answer is yes, it will be added. So the 3% tolerable band, students, is not applicable in this regard. And that exactly is the point, students. That exactly is the point. This is again the repeat of the same question. This is the repeated question, students. So you can just skip this one. This is a repeated question. Or may I delete this one? Page 84. Okay, so this is a repeated part of it. So this needs to be deleted. And there is an alternate tax regime which mistakenly has came here in this topic. Student, this is very simple one. This is your thin capitalization. This question, which is the rhythm, is a thin capitalization. This is you people can do it. There is no such new thing. You all know 30% of EBITDA. 30% of EBITDA is what is allowed as deduction. 30% of EBITDA is what is allowed as deduction. And the amount which could not be allowed as deduction in the current year, students, the amount which could not be allowed as deduction in the current year, what we do? We carry forward in the subsequent year. Students, we carry forward it in the subsequent year. The amount which cannot be allowed as deduction in the current year, we carry forward it in the subsequent year. And in the subsequent year, in interest expenditure, which you have incurred in that A transaction, that interest expenditure is added, and then the combined amount is then compared with 30% of EBITDA. The combined amount is then compared with 30% of EBITDA, and that is what it is. One MCQ question, students. It's a simple one. We'll do this and let's wrap up this session, and then in the evening at 6 p.m. we are going to meet up. ABC Limited, an Indian company, paid interest on loan taken from a wholly owned subsidiary PIX Inc. So ABC Limited, an Indian company, paid interest on loan taken from a wholly owned subsidiary PIX Inc. UK for 25 million, students. So loan taken is for 25 million. The TPO identified the following uncontrolled observation to arrive at this ALP. So students, in this particular case, students, what is the situation? Observation 1, 2, 3, 4, 5, 6. So if you see the interest rate, the first thing, students, you need to do is that to arrange the data in the ascending order, lowest to highest. So this is 1, this is 2, this is 3, this is 4, 5 and 6. So that is the ascending order. And then obviously 6, I just now told you, if the data set is less than 6, only then you go with the average. 6 or above 6, arithmetic, you go with the range concept. Range concept takes 35% of the data set. Data set is 6, so it comes to around how much is this for us? The first one, student. In this context, quickly. $2.1, students. 2.1. So if it is 2.1, as you all are aware, students, if it is 2.1, then you go to the next one. Then you go to the next one, 3. And at 3, what is the number? At 3, it is 8. In my sequence, just have a look. At 3, it is 8. Then next is 65% of 6. How much is that, students? 65% of 6? 3.9. At 3.9, then we go with 4. Go with 4, students, and at 4 it is 12%. At 4 it is 12%. So 8 and 12. So this is what it is. Students, evening, students, when I meet you at 6 o'clock, be careful. Evening, when I meet you at 6 o'clock, students, there are capital gains also, that is there, TDS is there, and one important case law which I'm just targeting for my evening class. Okay, one important case law, chapter 6 says Supreme Court ATI decision going to come in the exam. Going to come in the examination, capital gains in that, partnership, slum sale, and the ULIP, and the TDS and TCS. So let me target the evening class in that context, and also in the evening. See you then, students, at 6 p.m. Link of this video, link of the notes are there in the description box, students. 6 p.m. it is there. Share this video, students, across, and in the evening, tell your friends also to, without fail, join the session. It is a make or break situation, students, with all of you. Share this video to across to the students so that all of them can take the benefit. See you then, students, in the evening.
Thank you, sir. Thanks for the wonderful session. The next continuation of the session will be happening at 6 p.m. today in the same SIRC YouTube channel. Students can join at 6 o'clock. Thank you so much, sir. This session will be recorded and it is available in YouTube in the same link. So students can do for future reference also. Thank you so much, sir.
Thank you.